Speakers we got. I know most of you, but I'll introduce myself and let the other speakers introduce themselves. Andrew Lewis, live over around Columbus. This is my family here, and went to Mississippi State, did ag econ there. I've been working in agriculture ever since, and currently do real estate work and work in the crop insurance under Certus Ag Group. This is why we're here today. We're trying to keep from paying Uncle Joe. We're trying to minimize that, I guess you may say. Tax avoidance. We're trying to figure out how do we keep more money in the family, more money in your pocket. Just as a question, see how financially astute we all are. Of course, Charles and David will go into some of this later, but has anybody got any idea what you stand to lose if you don't prepare from a estate planning perspective? What percent? 40? Is that what the 40 is? Yeah, so 40% is what you stand to give Uncle Joe. What about when you sell an asset, sell a property, being rental property or a piece of real estate? What do you stand to give up there if you don't do a 1031? 30%? Right at, sir? 30% or more is what you're going to hand over to the feds in that situation. So this needs to be a spot for us to learn. So don't leave today with a question that you've got. Don't leave that unanswered. You know, ask, raise your hand, ask a question. We certainly got a lot of expertise in this room. There's a lot of experience here. I do want to point out a few people before we get started, just because I know everybody doesn't know everybody. Keith Morris is in this room. A lot of y'all have met him, but he's got 37 years working with Shell Oil, negotiating oil contracts internationally. You think about the expertise that's sitting there. Chad over here does business and farm management consulting. There's 100 plus years of real estate experience in this room. Charles Allen will be one of our speakers. He's one of the best, if not the best, tax attorneys that we have in this state. David Gorenberg, he'll be our speaker on 1031s. He's been doing 1031 transactions for, I think, right at 30 years. Isn't that right? Right at 30 years. And he teaches this information he's going to present to us. He teaches all over this country. Got a lot of experience there. Sam's going to talk to us. Sam Franklin's going to talk to us about some creative 1031 options that are out there that a lot of people aren't aware of. And again, make sure you ask questions. Stop any of the speakers. Nobody's going to be upset if we stop a speaker and ask questions. Take time for that, because that's typically where we're going to learn the most. I'll tell you that we did some of these same kind of meetings, most of the same content out in Oklahoma. I guess that was in October. We did it for 4 days in a row, and I can tell you I personally learned something new every day from the three guys we got speaking today. And a lot of that came from the crowd's interaction. You know, somebody asking a question in a little bit different way. They were facing some kind of problem, and they asked that question. So again, that's how we're going to learn. And last but not least, a lot of the Mississippi Land Bank guys here today, and they've helped sponsor this meeting. We appreciate them. But everybody that doesn't work for Mississippi Land Bank, I've been told by Matthew Kimbrough that there's going to be a 0% option, finance option for the whole year of 2024 for all the participants. So make sure that you've got to sign up over here for that.
He just told me it was actually a negative interest.
There we go. Yeah, Chad's negotiating for us already. So, but we certainly appreciate Land Bank and everything y'all do. And so we'll let Matthew, or I don't know who y'all have got decided to stand up and say a few words. Matthew, we'll let you stand up after Sam before we eat and say a few words there. But certainly appreciate y'all being here and participation in that way. Is there any questions before we get started? If not, David, I'm going to hand it over to David. He's going to start us out on the 1031s.
Thanks, sir.
Here.
Oh, I need that. I forgot. You guys. Thanks, sir. Good morning, everyone. I'm David Gorenberg. I'm not from here. You might detect an accent. This is Philadelphia or New Jersey. I actually live in New Jersey, not far from Philadelphia. That's the bio that my mom wrote. I'm not going to make you read it. I'm not going to tell you what's up there, except that I've been a licensed attorney for 30 years, 32 years now, coming up on 33. I handled my first 1031 exchange transaction in 1992. And I've been doing them full-time as a qualified intermediary for about 24 years now. And in that time, I've been doing presentations like this all around the country. One of my goals before I retire is to do presentations in all 50 states. I haven't gotten there yet, so I can't retire yet. I still have about 14 more states to go. I can't get my boss to pay for me to go to Hawaii. I'm trying. I'm working real hard on that one. Normally, when I come to a presentation like this, I would tell you that I'm going to be here through the end of the day and I won't leave until the last one of you leaves. But I'm going to be leaving today around 12:30. So when we break, if you have other questions, grab me real quick. Otherwise, reach out to your folks from National Land. We'll schedule a conference call at your convenience. Real quick, why you should use National Land 1031 for your 1031 exchange. $50 million fidelity bond, $25 million E&O, $15 million cyber liability policy, 5 attorneys on staff, including me. Combined, we have over 100 years of 1031 exchange experience. So there's not a lot that you could face that we haven't seen. Each of us brings with us a slightly different perspective. And in addition to me, probably most relevant to you would be Max Hansen, who is, he's a rancher up in Idaho and Montana. Not Idaho, Utah. One of those places over there. Montana is the ranch that I went to. So there's a lot of stuff that I've learned from him over the years. Look, I'm basically a city boy. I didn't know what a center pivot irrigation system was until I sat down with Max. But now, when I'm flying across the country and I see those beautiful circles next to one another, I understand what they're all about. So 1031 exchange. So here's where I like to start with 1031. The government says if you make $1, you have to pay tax on it. If you want to not pay tax on that dollar, the burden is on you to prove that that dollar is sheltered from tax. Even if you make illegal income, you're supposed to show that on your tax return. That's what I call the Al Capone clause, because they were able to prove he had income that he didn't declare, but they didn't actually prove the source of the income. So the point is, if you make $1, you have to pay tax on it unless you can come up with an alternative. Section 1031 is a little cubbyhole where you can shelter dollars. And I'm going to paraphrase that. Essentially what it says is if you have real estate that is not your primary home or your secondary home, and you sell it to buy different real estate anywhere else in the country that will also not be your primary home or your second residence, then you can do a 1031 exchange to avoid paying the taxes on the sale of that first property. Simplified, you're going to sell Pennsylvania Avenue to buy Boardwalk and not pay taxes on the capital gain from Pennsylvania Avenue. That's all it is. It gets more complicated because none of us is selling just Pennsylvania Avenue to buy just Boardwalk, right? So the 5 attorneys on staff, we're kept busy all day, every day, answering technical questions that come up that are unique to your situation. And hopefully we'll be able to answer some of those for you today. It is important to remember this is not a tax-free transaction. You're essentially kicking the can down the road, but that's not a bad thing, because as part of your estate planning, what's ultimately going to happen is when you pass, your heirs will inherit the property at the fair market value as of the date of your death. So you do a 1031 exchange today, and you do another one in 5 years, and another one 7 years after that, and eventually when you pass, you've got all this built-in gain that goes away. And your heirs inherit that last property at its value as of the date of your death, never having to recognize the capital gain or depreciation recapture taxes. So Section 1031 can be incredibly powerful. How powerful? Well, let's see. You're going to avoid paying depreciation recapture tax on any of the improvements on your property. That's 25% of the depreciation that you've taken over the years would have to be paid back to Uncle Joe. You've also got federal capital gains tax, 15% or 20% depending on your tax bracket, plus state taxes. Andrew said 30%. If you're in the 20% tax bracket and you live in California, I know none of us here lives in California, but those folks are looking at over 33%. Connecticut, New Jersey, I'm at 31% if I'm in the top tax bracket in New Jersey. That hurts. 31 cents off of every dollar goes right to the governor and the president. I don't mind paying somebody who helps me work my properties, but the last time I checked, the governor and the president did not help me swap out a hot water heater or a garbage disposal or fix a leaky roof. If they want to get paid, they got to show up and work. That's the way I look at it. Oh, and then on top of all of that, you may have heard of this Obamacare tax, right, that we've had for a bunch of years now, 3.8% on top of all of that. So the 31% in New Jersey just became 34.8. California just became 36.8. That hurts. Do a 1031 exchange, all of that gets abated, gets pushed down the road, and again, if you die holding that last property, it all evaporates. So here's a real simple example. I like to think it's a simple example. Here's a taxpayer who purchased property a bunch of years ago for $200,000. He's selling it today for $900,000. He's going to have transaction costs and brokerage fees of about $80,000. So he's going to end up with a taxable gain of $600,000. And by the time we tally up all of his taxes, $209,800 in taxes. His $900,000 sale minus the costs of closing, minus the $209,000, gives him $610,000 to reinvest. That same taxpayer structures the transaction as a 1031 exchange. He'll still have the $80,000 in brokerage commissions and transfer taxes and recording fees and such. But now he ends up with $820. $820 versus $610. And the 1031 exchange administration fees for that transaction, $1,500, $1,600. $1,500 investment to save $209,000. Is there anybody in this room who would not take that return right now? If I told you, you give me $1,500 today, I'll give you back $210. We'd all take that deal. And that's what a 1031 exchange is. And I throw the dollars in there because, or the fees in there, because somebody's always going to ask, well, yeah, but you just told me I can save $210. How much is it going to cost me? And it's not like I'm an attorney charging you $500 an hour, big city law firm fees to set it up. It's a flat fee. All right, so here's what a 1031 exchange looks like. You all know what a real estate transaction looks like. You get somebody to list it for sale, a buyer negotiates a contract, money changes hands. It's that simple. Well, a 1031 exchange is not much more complicated than that. In fact, we try to keep it as simple as possible. When you're thinking of selling the property and you're talking to your national land friends about listing the property, it's also a good time to start talking about the 1031 exchange because there are timelines in the statute that the government imposes upon what you must do by which date. So if you start thinking about the 1031 exchange and get our office involved up front before the property is listed, you've effectively extended those time limits. At the closing table, a couple of things are going to change. We're going to make a couple little minor editorial changes to the closing statement. And among those are going to be that the funds will be directed to my office to hold on your behalf. We create a segregated bank account for every transaction. Your money never touches his, never touches his. Okay? From the closing table, from that day, you have 45 days to identify potential replacement properties, 180 days to close on what you identified. All right, so we'll talk more about what all that means in a moment, but today is day 0, today's the closing table. Tomorrow you'll get an email from us saying, here's what your deadline is. Oh, actually it'll start with, congratulations, you just sold this property. This is how much cash we received on your behalf. So you'll verify that we did receive what you expected we would receive. This is your 45-day deadline. This is your 180-day deadline. And staff will work with you to make sure you understand what needs to be done along the way. All right? Let's skip that one. One of the things that we have to talk about, though, is that it's also called a like-kind exchange. And the nice thing about real estate is that all real estate is like-kind to all other real estate. There are 8 pictures on the screen behind me. Each of those items is like-kind to the other. So I can sell a ranch, and I could buy a golf course. I can sell a golf course and buy a warehouse. I can sell a warehouse and buy multifamily or an office building. It's all like-kind. Real estate is real estate is real estate. It must be domestic real estate. But I can also sell timberland for ranch land, for residential land. It doesn't matter. I can also sell an easement. So if a utility company wants to come in and put a cell phone tower on the corner of your property, you can sell that easement, or you can issue them a long-term lease. And if it's a lump sum lease up front, you can take that cash and you can buy a Delaware statutory trust. Sam's going to talk about those in a little more detail in a few minutes. There's a lot that you can do with a 1031 exchange. The bottom line is, if you're thinking of doing anything that's going to change how you use your land, it's a good idea to at least consider whether a 1031 exchange might be applicable. Now, I talked about the time limits: 45 days to identify, 180 days to complete the purchase. It's calendar days, not business days. So we've got Christmas coming up. Everybody's office is going to be closed. Doesn't count, doesn't matter. It still counts. Thanksgiving was a 4-day weekend for a lot of offices. Doesn't matter. Those 4 days counted. Okay? And if your 45-day deadline is on Sunday, it's probably prudent to submit your designation notice to our office on Friday so that we can make sure that you dotted your I's and crossed your T's, and we'll talk about that a little bit as also. There are no extensions. So if you're, in fact, I get this call somewhat regularly, David, today's day 40, day 45 is coming up, I'm having a real hard time. Can I pay you an additional fee for additional time? I wish I could say yes. It's not my rules, it's the government's rules, it's the IRS rules. So no, you can't pay me a higher fee for more time. And when I say 180 days to complete the acquisition, it's actually 180 days or the due date of your tax return. So if we're going to closing today, 180 days from today would take us out into June, but your tax return was due April 15th. So you either need to file for an extension on your tax return or complete your 1031 exchange before April 15th. Okay? And I've seen people do, if you know exactly what it is you're going to buy, then April 15th isn't a headache. And if you're going to be closing in 30 days, then April 15th isn't a headache. But if you don't know exactly what it is you're going to buy, or if there are going to be some delays in closing, then it's prudent to file for that extension on your income tax return. There's actually a case about that in 1031 exchange world. A taxpayer did not actually file for the extension. They just took it. And the IRS sought to hit them with all kinds of penalties and such. And they fought it and went to tax court. And the tax court judge very pointedly asked, did you file for an extension? And the taxpayer's response was, no, everybody gets an extension. And the judge's response to that was, no, everybody who files for one properly gets an extension. And filing for an extension isn't hard. Submit a form, submit a check for what you think your tax is going to be. It's granted. They didn't file, they didn't get the extension, their 1031 exchange was denied. So make sure you have a good accountant, a good attorney, and do it right. Okay, so how do we identify the property? The identification that you're going to submit to our office needs to be in writing. We actually do everything digitally, so the writing will be electronic. It needs to be submitted to our office before midnight of day 45. The description of the property needs to be rather specific. Now, if it's got a street address, 123 State Road, that's awesome. If it doesn't have a street address, a legal description works nicely, right? Township this, range that, whatever, all fine. Also, if it's got a common name. Now, the regulations give the example of the Mayfair apartment building. Down the road from my house is Johnson's Farm. 5 miles down the road from my house. I can tell you exactly how to get there, but I have zero idea what the street address is. I'm sure the post office and the fire department know what the street address is, but I don't. The point is that if somebody says they're buying Johnson's Farm, and I look at it and say, yep, I know where Johnson's Farm is, and we can walk out there right now, we can see, yep, it goes to that fence, to that fence, to that fence, and here's the property. The point is that an IRS agent should also be able to show up and say, we know what you've identified, okay? And Johnson's Farm might make it a little easy by being all fenced in. Maybe Johnson's Farm here isn't all fenced in, but there's a post someplace or a marker in the ground. I actually saw one identification once where the legal description was the corner of such and such a road, northeast 100, whatever, however far it was, to the rock. Well, there's this big glacial boulder, and that was the corner of the property line. And then I don't think we see a whole lot of glacial rocks around here, but you understand my point. So street address, legal description, common name, that all works, again, so we can identify it reasonably if we walk into the community. How many properties can you identify? Well, most of our taxpayers who sell one property are going to buy one. Sometimes they'll sell one to buy two, but sometimes what you're doing is sort of breaking up what you're holding so that you can do some estate planning, okay? So rather than, we were talking to somebody the other day on Tuesday, currently it's in the grandchildren's, so grandpa started the farm, grandchildren have it now, there are 16 of them, and when it passes to the next generation, as of Tuesday, there are 32. And that'll probably be more by the time it actually passes to the next generation. And this gentleman is the one who's responsible for managing it. So he's got essentially 16 bosses, right? I wouldn't want 16 bosses. So how many properties can we identify? Well, the first rule, there are 3 rules. We only have to satisfy one of them. First rule says identify up to 3 properties, no additional questions asked. Not a problem. We identify 123 Main Street, 37 State Street, whatever it is, done. We need to be sure that we can close on the acquisition of at least one of those properties. If I need to identify more than 3 properties, especially if it's a situation like I just described, then if you're going to identify more than 3 properties, you want to limit your list to not more than double the value of what you've just sold. So if you sold $1 million farm, you're going to limit and you're going to identify more than 3, then the total value of those 3 should not be more than $2 million. Not that difficult. If, however, you choose to identify more than 3 properties and they aggregate to more than double the value of what you sold, then you should be prepared to close and complete the purchase of at least 95% of that identified value. Truthfully, you'll probably not fall into that bucket. 95 or 96 or so % of all of our transactions use that 3 property rule. 99+% of what's left use the 200% rule, and then there's some itty bitty little fraction that fall into the 95% rule. And almost every one of those transactions I've ever worked on, they're buying everything, so it doesn't much matter. Again, our staff, I, the other attorneys, we're all available to ensure that you understand what you need to do and that you get there without sort of stepping over the property line, if you will. Some simple mathematical rules that you want to keep in mind if you want a successful 1031 exchange, if you want to fully avoid the taxes. Rule number one is you want to trade equal or up in total value. You sold $1 million property, you should buy $1 million or more. Not a problem if you go down. In fact, we saw that there's some closing costs involved, and you're allowed credit for that. And you can also say, you know what, I want to trade down a little bit, and I'm going to pay tax on the cash I'm pulling out. And that's okay, but once you've pulled the cash out at the closing table, we can't change our minds and put it back in. So I always recommend leaving all that money in at the beginning. And if you want to pull it out at the end, that's different. But up front, let's leave it in. We also want to make sure that we reinvest all of the cash. So even if so let's say I sell a property for $1 million and I have almost no loan on it, so we'll call it $1 million cash deal. And I'm going to go buy a new property for $1.5 million. And our wonderful lender friends say that they'll finance 50% of that purchase for us. Not at 0% or negative interest, but they're going to finance 50%. All right, great. I'm going to buy $1.5 million. They're putting up $750. I only need to bring $750. Fantastic, I just bought the property. But I sold for $1 million. So there's still $250,000 left on the table. That $250 just became a taxable event. Unless I identified more than one property and actually used that money to buy that property. So while it's very generous that they're going to offer to finance 50%, ask them to bring the loan down a little bit so that we can spend all of our cash. Okay? Let's use our cash first. If you really want the 50% financing, take $500 at the purchase and another $250 afterwards. And then when you take that second $250, there are no restrictions on what you want to do with it, right? At least not as far as the IRS is concerned. As far as they're concerned, perhaps. Okay. Moving on. Oh, some people call up periodically and say, look, I'm doing a 1031 exchange. Is there anything I need to do to the contract to make it a little different? Honestly, there isn't. The notice of the fact that you're doing a 1031 exchange is part of what we do during the course of the transaction. But if you insist on having notice or some special language in the contract, here's an example, and we can make sure that you all get a copy of these slides after today.
Can you go back a slide
Whoop.
and speak to the equity and debt?
Thank you. So some people would come in front of the room and say, look, you need to trade equal or up in value, equal or up in equity, and equal or up in debt. Anybody here a math major? If you trade equal or up in value and equal or up in equity, the debt balances. If there is debt on your existing property, when you buy your next property, you need to replace that debt, either with new debt or cash. Some 1031 folks just don't understand that if I can put 1,000 examples on a whiteboard right now and you'll see it always works. If we trade equal or up in value and we trade equal or up in equity, the debt has to balance. If I sell a $1 million property and I pay off a $200,000 note, that leaves me $800,000. If I buy my replacement property for $1 million all cash, I've traded equal or up in value and equal or up in equity, and I replaced that debt with new cash. And I actually had a transaction similar to that a couple of years ago. The gentleman only owed literally just a couple of $1,000s at the closing table. When he bought the new property, he didn't like having that debt to equity ratio on the property. So he actually paid cash for the new property because he couldn't finance it to 50 or 60% like he would have wanted to. He paid cash for the property, and then a week later, he did a cash out refi. That you can do. You can pull cash out after the transaction. Don't pull it out before or during. So here, where he wanted, I don't remember, 60, 70, whatever percent he was able to pull out, he did. And he actually used that newfound equity, if you will, to buy a second property. You can do that. But he also could have just as easily used it to buy equipment or go on a cruise or, buy his daughter a new pony, whatever it was he wanted to do. Other questions while I'm stopped here? Okay. One of the key things in the 1031 exchange rules are that the same taxpayer who started the 1031 exchange must complete the 1031 exchange. So here's a real black and white example. If I sell the relinquished property, Andrew can't buy the replacement property, and we call that a 1031 exchange. We are clearly two different taxpayers, right? But what really happens more often than not is the taxpayer who sold was a guy who bought the property when he was single and now he's married. Or bought the first property in his individual name and now he wants to know, can he buy the property in an LLC or in a trust? And those things work. So David can sell the first property as David Gorenberg, and I can buy my new property in DG Realty Holdings as long as I am the sole member of that LLC. Excuse me. Similarly, if I own the first property in DG Realty Holdings LLC, but I want to kill that LLC for whatever reason, I can buy the new one in DG Real Estate Holdings LLC. Brand new LLC, again, so long as I am the sole member, it's fine. A lot of us, when we create LLCs to buy real estate, excuse me, when we create LLCs to buy real estate, we use the street address of the property or some name similar to the property, right? So Clarksdale Realty Holdings or 123 State Street LLC, that kind of a thing. Well, if I bought it if I own my first property in 123 State Street LLC and I'm buying my next property on 2nd Street, State Street LLC doesn't make a whole lot of sense for a property on 2nd Street. So I kill 123 State Street LLC and I form 2nd Street LLC, and that's fine. Again, so long as I'm the sole member. And if I choose to put my property inside of my living trust, I sold it in my own name, I can buy my new property in my living trust. That also works. Some people want to play with title before we sell the old property, and there is zero reason to do it. If you're going to be buying the new property in an LLC, that doesn't mean you need to play with the title on the old one, especially if it's already under contract. Why muck it up? Leave it alone, sell it in your individual name. You're not changing anything. You're not adding any layer of protection if you're already going to closing. All right. So what we've talked about so far this morning is the idea of a forward exchange where we sell first and buy second. But there's also the idea that you could buy the new property before you sell the old property. And especially in a situation where there's limited inventory, if there's property you want to buy, that seller may not be willing to wait for you to market your existing property, find a buyer, get it to closing, and then you're going to go buy from him in 120 or 150 days. Not likely to happen. So let's talk about a reverse exchange. In a reverse exchange, what will happen is you will lend to me the money to buy that property on your behalf. I will form an LLC and buy that property for you in the LLC. We are the member of the LLC. We lease the property to you on a true triple net lease. You don't pay me a penny. You manage the property, you collect the rents, you till the soil, whatever it is you're going to do with it. When you sell your old property, that cash will flow through me as it would in any other 1031 exchange, but then we use it to pay back the loan that you gave to me to buy the property in the first place. And we now give you your property. So you had borrowed the money from the bank or you pulled it out of your own bank account. We give it to you so that you can either put it back in your bank account or pay back the bank. And we give you your property. The IRS has blessed that procedure, and we make sure that you understand it along the way. I've kind of simplified it here for timing purposes. One of the seminars I teach is 3 hours just on reverse exchanges, so I don't think we want to stay here until after lunch just talking about those. But the idea is that you can buy the new one first if it makes sense. The other thing to keep in mind is that, I went the wrong way when I pushed that button. We can make improvements to the real estate. If we sell the first property for $1 million and we find other property that we want for $800,000, but it needs work. What does it need? It needs a center pivot. It needs fencing. It needs repairs to the barn. It needs a new gravel road, or it needs new gravel on the existing road, whatever it might be. We can do that. That's an improvement exchange, right? So what will happen is you'll sell your old property. The $1 million comes to me. We find the new property. I create the LLC. You lend me the money. I have it in the bank. We buy that property on your behalf. You hire contractor number 1 to go fix the roof. He fixes the roof. We pay the invoice. You hire the second contractor to come out with the gravel to re-gravel the road. You approve the invoice. We wire him the money. Somebody comes out to put in the fence. You approve the invoice. We pay the fee.
I'm just going to tell everybody, one of the guys we're fooling with that's doing a 1031 with him right now called him and asked about $50,000 worth of deer stands. And they're like, as long as they're attached to the real estate, right? It's real estate. It's a real estate improvement. So, you know, you see these guys doing these swaps, there's a lot of stuff that can happen in these 1031s that people have been missing out on.
There's a lot of stuff that can, if the levee needs to be repaired or built up, or you need to put a drainage swale in, or if it's improvements to the land and it's attached to the land, that's fine. It'll, absolutely. And let's go back to the barn for a second. If you need to pay an engineer or you need to apply for permits, those fees also count. And if on day 180, at the end of the day on day 180, the foundation is there, the poles are up, the siding is on, they're still working on the roofing, but they've lost sunlight and the guys are going home, it's not a 100% complete barn, it doesn't matter. We're substantially complete, we're close enough. If, however, on day 180, what we have is a pile of steel, that doesn't count, right? The foundation is there, but otherwise we just got 4 or 5 truckloads of steel, that's not going to count. I rarely run into that situation, okay? So that's an improvement exchange. And there's not a lot that doesn't count. Wells, septic, deer stands, grain bins, all of it. I mean, you've got to put up a silo. What doesn't count is stuff that isn't going to be clearly attached to the land. Like, you're not going to go out and buy equipment, right? Nothing with a John Deere label on it is probably going to work. Sir?
What about land forming?
I don't know land forming. I'm a city boy.
Dirt work.
Oh, grading work? Absolutely.
Yeah.
Absolutely.
You gotta watch your timing though. You know, there's a certain time of year when you can do it on a lot of places, right? And so your 180 days on the completion side is gonna be sensitive to that. Like these timing things, like one of the things, every time I hear somebody give a presentation about that 45 days, I've had folks, you know, they have their closing on November 15th. All right, well, have y'all ever tried to get something done during Thanksgiving, deer season, duck season, and Christmas? Like, you do the math on that, you just went through all of that, and nobody's calling you back. I mean, some of these time periods, you really need to look ahead on some of these time periods when you're fooling with them, because they'll bite you.
Yeah, land forming, whatever the purpose of it is, whether it's you got to level it so you can put a barn on it, or you want to grade it so that something runs off of it, absolutely that counts.
Expand on that. You talked about the foundation and the steel. And Mark's talking about the timeline and, well, you know, certain times of year. This may be a question we have to get answered to to count as having steel erected on that foundation.
So here's, Mark just whispered no, and I'm probably going to agree with him because what the IRS regulations say is it must be substantially complete, but they didn't give us a number. I think we can all agree that 30% is not substantially complete. But is it 51%? Is it 90%?
There's what they're calling technical failures of these 1031s, and there's, did you get audited and did you get caught? Might you have paid the dirt man by 180?
Yeah, you've probably paid the dirt man.
The IRS man ain't coming out.
Right.
But yeah, so there's being stupid. I've seen a lot of people do stupid stuff after the fact. But mostly don't get caught if they're not guilty.
Yeah, I mean, to Mark's point, he's going to give you an invoice that says we graded the ground and you paid it and it was paid on December 15th. But you and I both know he's running out to a deer stand in 5 minutes and he's not going to be back for a week.
Can you speak to the solar and wind leases? I think a lot of folks here will live.
So every state does what I call conservation easements a little bit differently, right? I'm using a very broad term. Water conservation easements, all kinds of, and again, every state does it a little bit differently. If the state or the county or the municipality is giving you a one-time check to limit your use of some portion of your land, you can take that check and what you've just sold is eligible for a 1031 exchange.
WRE check.
There you go. So the last one that I had was similar to this was out in Colorado. I forget their name for it, but essentially the state of Colorado paid my taxpayer a lump sum of money for him to never touch his wells again. Well, if he's never touching the wells on that field out there, it's going to go back to nature pretty soon. And that's what they want. And that's fine. So this gentleman now took this big check and he bought Delaware statutory trusts. Sam will talk more about those later, but essentially you're buying a piece of property that somebody else is going to manage for you and you're going to get a check once a month, and in 4 or 5 or 6 years you're going to get an opportunity to do another 1031 exchange, and you're never going to have to touch another piece of equipment on that piece of ground. Here's where it gets real extreme. I had a taxpayer a bunch of years ago in New York who lived in a 3-story brownstone, just a brick home, 3 stories tall, surrounded by a whole bunch of other ones exactly like it. Over the years, 3 sides of that city block had been knocked down, so it was just her side of the city block left. What she didn't know was that that area of town is zoned for 6-story construction, and all of these homes were 3 stories tall. A developer had bought the rest of the city block, and he was going to each of those homeowners to buy the air rights, the 3 stories worth of air that she didn't build. Right? And her reaction was, I own 3 stories worth of air, essentially 35 feet worth of air, and I can sell it to somebody else and get money for it. Not only did she get money for it, she got well into 6 digits for it. She bought a Delaware statutory trust, and now grandma, who's barely making ends meet, is getting a dividend check once a month, essentially for the rest of her life. So there's a lot that you can, like I said, if you're planning to do anything, sell any interest whatsoever in your land, it's worth asking about a 1031 exchange. I will never let it.
Rules on solar, because that's solar or wind.
Yeah. Somebody wants to come in and they're not necessarily going to buy. They want to lease from you the back third of your property. They're going to give you a one-time check for a 99-year lease, or they want to put windmills up every 1,000 feet or however close they put them, or somebody wants to put a billboard on the corner of your property that touches the highway. Again, if you're getting a one-time check for something like that, that check and what you just sold are eligible for 1031 exchange. Please.
But that's a lease.
Yeah, it's a 99-year lease, but if they're giving you if they're paying you once a month or once a year, you're not likely to be able to make it work. If they are giving you a one-time check, you can make it work.
And in 30 years is the minimum.
Yeah, that leasehold interest needs to be 30 years or longer.
And so you could sell the annuity, basically, for that, in exchange for that one-time check, and it'd still be a lease, and that's an exchange. Got it?
And what
All you gotta do is discount the cash flow to sell the cash flow.
And what I'm seeing people buy are the Delaware Statutory Trust that Sam's going to talk about. I thought I saw a hand over here.
Yeah, so I was going to say the same thing, Mark. If you want to do a solar cell tower billboard, you're going to get a lease. Typically, it's going to be 25, 50 years, and then 5 years or 5 years. They're not going to probably pay you up front. But I'm telling you, the number of people that will buy that income stream.
Yeah, right.
Before you accept that money, you certainly should look at 1031 opportunities that might be available to you for that and the Delaware Statutory.
And you're going to get your accountant involved, and you're going to get your tax attorney involved, and we're all going to have a nice, pleasant conversation to make sure that all of the paperwork puts us in a position where we can make it work.
And guys, so for those that hadn't seen those solar and wind leases, those appreciation clauses for those, it's a fixed financial instrument. The appreciation clause is usually 1.5%, 2%, real small. What's inflation? 4. Okay, so who thinks that's going to keep up? So would you rather have that long 30 years that's got that fixed appreciation schedule in it? Or would you rather 1031 out and take your chances with real estate or some other investment for 30 years? It's a kind of a no-brainer. When you look at that lease, that cash flow, people will buy that cash flow.
Yep. And just to give you one more fresh example, and then I'll open up for more questions. There's a farm near me, the last operating farm in the township in which I live. It's third generation now. The kids went to school with my kids. They're getting ready to be the full-time managers of it. But it's hard for 2 kids to run this. I mean, it's not thousands of acres, but it's hard for 2 kids to run the farm. She's running the bakery that's in the farm business, the sweet shop and stuff, and he's out there planting corn and strawberries and beans and whatever all else he's planting. And I'm trying to convince them, not that I get a huge paycheck out of this, because I don't, if they sell the conservation easement to the county, which essentially will keep developers off of that land forever, they get a lump sum check for the conservation easement. They can now take that check and invest it in Delaware Statutory Trust, and if next year we have 180 straight days of rain and they can't grow a single ear of corn, it's not going to matter. Or if they get 240 straight days of no rain and they can't grow a single ear of corn, it won't matter, because they'll have the income stream from the Delaware Statutory Trust. So, I was just going to say, I'm not sure how close I am to my time. Thank you very much for waving fingers. So I've got a few more minutes left. Questions I can answer for you folks. Sir.
One of the things to note, because I see this a lot in Mississippi in particular, is the real estate attorney also serving as QI, or the client CPA serving as QI, and the fact that that doesn't work.
It doesn't. And to Charles's point, your local real estate attorney is probably a real good guy. He's probably a really bright guy, and he probably knows more about real estate transactions in the state of Mississippi, certainly than I do. But if he doesn't do 1031 exchanges full time, there's probably a revenue ruling or a court case that happened last month that he's not aware of that could impact your transaction. So my personal recommendation, look, even if you're not going to call land 1031, it's not worth saving a couple of dollars to back yourself into a corner where the IRS says, oh no, your attorney didn't tell you. You can't do that anymore. Or you could have done it if you did it this way, but you didn't. Penny wise and pound foolish is the old phrase.
David, I think the point to clarify there is if your real estate attorney is transaction or has done any legal work for you within the last 2 years leading up to that, then they're considered an agent.
Yeah, well,
If an agent of yours is the QI, then the same as you getting the cash, whole deal's busted. That's what I see.
yeah, oh, that's the point you were making, and I was looking at it from a slightly different angle because I know of attorneys around the country who will have the law office of David Gorenberg, and then they'll have DG 1031 LLC, a separate corporation, which technically,
Whether that
yeah,
works or not has not
and
been tested.
technically, that's not illegal, at least as far as the IRS is concerned. Whether it violates state or local bar rules, I'm not going to ask, but you're still not getting the best representation, right? You don't want the guy who does the oil changes on your truck to also be the guy putting a new roof on your barn because he may not be the right guy to do it. So
I see a lot of them that don't do it. They just, it's the same law office that's doing the QI and
Yep.
all that. And I think people just don't know, but that is strictly prohibited in the 1031 regulations.
well, and the thing that I see a lot is that if your law office is on the second floor, my law office is on the third floor, I'll refer all my 1031 exchanges to you. You refer all of yours to me. There's no formal handshake agreement. There's no written document. We just do it that way. And if Charles doesn't do 1031 exchanges all day, or if I don't do 1031 exchanges all day, you're not necessarily getting the best representation. But Charles, thank you. Those are good points. I think I'm out of time. I'm going to be sitting in the back of the room.
Let's take 5 minutes. The restroom is out these doors, straight up there. Just use the restroom. There's drinks here. 5, I'm back to 11. So Charles.
There's just 2 or 3 more slides. You want to scroll through them?
That's the last slide.
Does the seller generally contact you, or does he have his attorney?
Either way. Sometimes the seller will call me and say, this is my attorney's name, and this is my real estate agent's name, and I'm going to make an introduction. And sometimes it's an attorney that I've been working with for years, and he says, Bob's going to be giving you a call, keep me in the loop. So, either way.
We do some here. We probably do more in the Clarksdale office of the land bank. Us and it's the Stark office, the bigger land office. So we do it through. It's most of our attorneys that are, they use a third party qualified intermediary.
As long as they're using a third party and it's a skilled and knowledgeable third party, I'm okay. I'd rather them use us, but that's okay.
Well, I'm not sure. I'm not sure of their expertise on that still. So I'm intrigued with this, and I appreciate it.
I appreciate the hearing.
Land 1031.
Yeah, who invited you here today?
Andrew Moore.
Yeah.
So we're sponsoring it.
Oh, that's right.
Yeah,
Yeah. So they're the people we reach out to. Like I said, I'm from New Jersey, so don't hold that against me. I'll do what I can to help them.
All right, well, I appreciate it. Thank you.
Thank you, sir.
Andrew got access to that PowerPoint?
Yes, sir.
Hour right there.
And the 2 younger guys are younger than me. They're thinking outside the box. Until they're told no, they're thinking outside the box. So, I'm thrilled. Between the 5 years, somebody raised a question
When you work on an island, you have to be.
So forget about those jobs. Straight along. Don't get mine. Don't get your feet wet on the opposite side.
Really good, enjoy it. I appreciate it. So we'll follow you. Love Mississippi. Thanks. 2 hours.
All right, Rob.
New Jersey or Philadelphia?
I live in New Jersey, but I say Philadelphia because 8 miles. I can't remember 15 miles. Thank you, sir. No, I didn't want to be halfway down the road and have somebody reading me on my cell phone. David, you didn't take it? Yes, sir. So we'll get lost right away. Charles, you ready?
Yeah, I'm ready. Let's see.
Cool. So I'm going to go sit in the back of the room, and when I stand up
Good
to
job,
walk out,
man.
I'm not
Yeah.
being rude. So
I didn't mean to get you on the agency. I just
No, that's
see
all right.
that-
No,
I'm
I-
telling you, and I had 2 different people. One of them is a client of mine. Yes, in Indianola, came up to me after and said, "Man, I hope mine doesn't get looked at because my local attorney did it all." You know, and I'm just sort of preaching it. We used to actually do some QI work mainly as a favor because we had.
I know a lot of people do it that way.
But
As
we had a
favor.
big referral source of these real estate folks that were sending it to us. But it got to the point where we
You almost need one attorney just to do that.
yeah, we can't do it for a client.
Right. I've had attorneys ask to hire me as a consultant. I said, "Well, 1031 business." I said, "Why? You can charge $350 or $500 an hour, whatever it is, to review my documents. You can make far more money reviewing my documents than paying me."
No, that's where we were like, we're done with this.
Flip it on.
All right. Oh, it's right here. Got my timer. All right, let's talk a little bit about some income tax and some estate planning. So my name is Charles Allen. I'm a tax attorney based out of Oxford, but I grew up in Greenwood and spent a lot of time in this building actually growing up, golf and tennis, things like that. So appreciate everybody being here. Please don't hesitate to stop me and ask me any questions on any of this. Happy to take questions in the middle of the presentation, so don't hesitate to interrupt. All right, so when we're talking about income tax, the first thing that we have to know is what is our basis. If we don't know what our basis is in the property, then we can't determine the tax consequences. And if you go to the IRS and say, I don't know my basis in my property, the IRS is going to say, well, if you can't prove it, then it's zero. So the presumption is on you to prove what your basis is. So understanding the concept of basis and the adjustments to it is critical to determining the tax consequences of pretty much everything you do. You know, gifting assets, selling assets, holding assets until death. The easiest way to understand what your basis is it's what you paid for it. I go buy some Coca-Cola stock for $100. my basis in that stock is $100. So once I sell that stock for 150. Well, amount received 150 less my basis 100. My gain's $50. That's what I pay the tax on. Obviously, the basis becomes more complicated than that, particularly on assets that you bought a long time ago and may not have good records, or assets that are inherited or passed through over time. So tracking basis is a very important and overlooked concept of tax. In general, the recipient of a gift is going to take a carryover basis in the assets received, thus their basis equal to the donor's basis. So grandfather passes down some land via gift, not at death, then the recipient of that takes the land with a basis of what the grandfather had in it. Holding period for purposes of determining the 1-year holding period for long-term capital gains also carries over. So assets that are held until death and included in the gross estate of a decedent receive a basis adjustment to the fair market value of the date of death. We're optimistic here, so we're going to say it's the step up in basis, but it's actually a basis adjustment, which means it can also step down. When you're talking about a lot of the agricultural land around here, you don't really have to worry about the step down in basis currently, but it is step down as well. So let's say you had a stock portfolio that's got a built-in loss in it. You'd be better off selling that, recognizing that loss, and then dying with the loss, because the loss is going to go away. Whereas it's the opposite with gain property. So you can do a lot of really good income tax planning if you're willing to die as part of your plan. So that's the downside to it. So the basis rules, once you get an entity involved, they become a lot more complex, because now we're actually tracking 2 different bases. So if I own stock in a corporation, I have a basis in that stock. That's called my outside basis. My outside basis is essentially what I paid for that stock in the corporation, or what I contributed to create that corporation to get the stock in exchange. The corporation itself has its own assets. It's what actually owns the land or the business or whatever, and it has a basis in its assets. That's called the inside basis, inside the company. So now we're tracking inside basis and outside basis. This does create a discrepancy in basis, and sometimes can result in double taxation even outside of a C corporation, and we'll cover that in a little bit. So lots of opportunities for basis planning, simple as holding assets until death. There's some upstream planning we can do to take advantage of the older generation's unused estate tax exemption. There's just a whole lot of creative ways that we can structure things and have powers of appointment, ability to confer powers of appointment, things like that for income tax basis that we're really focusing on now, that probably was not focused on, say, in the year 2000 when the estate tax exemption is $1 million. Now our exemption's so high we can creatively use some exemption via triggering estate inclusion and getting step up in basis. So that is, there's a lot of different ways we can do that. FLP, this is a very common, how many of y'all seen FLPs? Family limited partnerships, things like that. So an FLP is just a state law limited partnership. It's an LP. At a basic level, the family members would hold a percentage of the business and would profit in proportion to the percentage they own. Certainly we can adjust that some in the partnership agreement with targeted allocations and things like that. Generally, an FLP is established for traditional reasons, would not have outside owners, though a state law limited partnership is certainly not limited to family members. A lot of times in the FLP, though, we will limit that in the partnership agreement to certain people, but nothing in state law would limit that. To have a partnership, you got to have 2 partners. So one person cannot be a partnership. The 2 different partners that you have, the first has to be a general partner, and you can have multiple general partners, but you have to have at least one general partner. The general partner is responsible for the management of the FLP. They have unlimited liability, so a general partner of an FLP can be sued personally for a judgment against the FLP. For that reason, we typically have an LLC that serves as the general partner, because now the LLC creates a liability blocker. So we put that LLC there to prevent that. So that's a lot of times why you'll see an LLC as the general partner of an FLP. The other thing having that LLC does there is allows us to have certain management provisions within the LLC itself, which then in turn manages the FLP. Limited partners, they're limited with regard to their liability, but also limited with regard to their ability to participate in the management of the entity. If a limited partner, in their capacity as a limited partner, is participating in the management of the entity, then they could be a deemed general partner. There's a case came down about 2 weeks ago where the IRS was actually successful on deeming a limited partner to be a general partner. That was actually an employment tax case. But the same thing can happen for liability. So a limited partner who is limited in name only, is the language the IRS used there, could also risk liability. Management reasons keep family investments under one roof rather than having many different investments spread out and disorganized. From estate planning context, we use these to pass wealth, family assets, farmland, things like that, down to the generations. It gives us a couple of opportunities. Number one, a lot of times you'll end up with a business where one of the children goes into the family business. They go into the farm. The other two go do their separate thing. They don't care about it. But we still want them to have some benefit of that. Limited partnership interests are a great way for someone to have an economic interest, but not come in and ruin the business because they have no say, no control, and they may not know what they're doing. The other thing you can do is discounts. Y'all familiar with discounts? It's the same concept of, let's say you have a piece of real estate that's owned 50-50 tenants in common. You know, me and my friend over here. Well, my 50% is not necessarily worth 50% of the 100% of the fair market value, because whoever buys my 50% is now partners with my buddy over here, and they may not like my buddy. And so there is an inherent discount associated with that, with like an undivided TIC interest, tenant in common interest. The same is true for these entities. If you are buying a limited partnership interest, you have no say, no control. You don't control distributions. You're solely at the whims of what the general partner decides to do. Well, you're not going to pay necessarily the pro rata fair market value of the pro rata percentage of what the net asset value is. So if you're buying into a partnership that's got $1 million, you're not necessarily going to pay $300,000 for a 30% interest because you have no say, no control, no way to get out of it. You're kind of stuck there. And so what that creates are discounts known as discounts for lack of control and discounts for lack of marketability, because there's not a big market out there for them. Those discounts essentially end up anywhere in the neighborhood of 25 to 40%. So if we're trying to pass down $1 million interest in an FLP and it's a limited partnership interest, and we take a 35% discount on that, then we can transfer $1 million of net asset value, but only cost us $650,000 of exemption or estate tax exemption. So, and obviously the bigger the numbers get, the more that leverage on the discount makes a difference. So there's a lot of we would never enter into an FLP for tax reasons. You have to have a non-tax business reason for setting up an FLP in order for the IRS to respect those discounts. But that's why we do it a lot of times. But we would never say that. So an FLP is the owner of the actual assets. So the FLP goes and buys, a building, farmland, something like that. They actually own those assets. And so since the partners don't actually own those assets, we're looking at the inside basis, the basis inside the entity. And then, of course, the partner has a basis in their partnership interest, the outside basis. So what happens at death? So at death, the partnership doesn't die. And so the partnership doesn't get a step up in its inside basis. The only step up you get is the outside basis. And so the partner steps up their outside basis up to the fair market value. And again, it could be down to, but up to the fair market value. And so now you're left with this discrepancy. Well, in the partnership context, and the discrepancy is we got a high outside basis, low inside basis. In the partnership context, there's a fix for that. It's called a Section 754 election. And once this Section 754 election is made, then it allows a basis adjustment under Section 743 for a sale of a partnership interest or a partnership interest is transferred by death. So now the person that receives that partnership interest gets what's called a notional basis adjustment to the inside basis of the partnership assets to now prevent that sort of double taxation, if you will, because now they have an inside basis step up equal to the outside basis. So with that 754 election in place, and again, this has to be made, the 754 election has to be made in the year of the event unless it was made previously, because once it's made, it stays in effect. So having that step up in the inside basis prevents us from having double taxation. An S corporation or a C corporation does not have the 754 concept. So that is where you get your discrepancy in the basis. So if you have an S corp, you do get a step up in the outside basis, but there's no corresponding step up in the inside basis. So now what happens? The S corp goes and sells that property. Because it's determining its gain or loss based on the inside basis, it still has the high gain. And so now it distributes that gain out via K1 to the partner. There's no notional basis adjustment to offset it. And so now the partner still has to pay the tax. Ultimately, on a liquidation, you can balance yourself out because the partner has an increased basis and can take a loss on the liquidation. But that may be years away, or it may not happen at all. And you also may have timing and character issues there. So you really do have to be careful there. The other thing I'll say real quick about the high estate tax exemption and FLPs and discounts. A lot of these FLPs were set up when we really needed these discounts. We really wanted them. The estate tax exemption was $1 million, something like that. Today, we may not actually want those discounts, and so it is important to review sort of old and cold FLPs, partnership agreements, things like that, to make sure that we are not getting hit on our step up in basis via a discount from the fair market value when we don't really need it. Let's say you have plenty of excess estate tax exemption, not a taxable estate, you're not worried about it. Well, you still could lose 40% of that basis adjustment via a discount on that partnership interest. And so a lot of times we've amended partnership agreements, given certain rights, call rights, withdrawal rights, things like that have eliminated those discounts intentionally. So,
did you tell them what was happening in a couple of years?
We're going to get to that. I got a slide on that. Yeah, we're going to talk about the estate tax exemption, but anyway, I guess the point there is, just because a FLP was done 20 years ago, you got to stay on top of these things. You can't just set your plan in place and forget it. You have to actually administer it and monitor it. So. All right. So real estate owned by a C corp. So it's very common in this part of the world and Midwest everywhere that you have a lot of this agricultural land that's been in the C corp for 30 or 40 years. The reason it was set up initially was, liability, things like that. It was the right call. But now we have all of these different LLCs and flexible entities and stuff. And so we don't really use C corps today, other than very specific reasons, primarily looking at like a qualified small business stock setup or something like that. So when you have this property in a C corp, and let's say your basis is, $1,000 an acre or something, the property's now $7,000 an acre. Well, when you pass away, you still get the step up in your basis on the C corp, in the outside basis, but the C corp still has all that gain built in. There's really no way to prevent double taxation there, like you're already in the double taxation environment. So when the C corp sells the land, they're going to pay tax on 21%. They may distribute that out, and you may liquidate, and you may have a loss, but you've got an individual loss versus a C corp tax gain over here, and so there's no offsetting of them. We can fix that with an S corp to an extent, and I'll cover that here in a minute. So since we don't have the 754 election, holding C Corp until death does not create a stepped up basis in the inside basis, only outside, and thus at death, a shareholder who inherits will likely have a large basis in the stock itself, but there'll be a lot of inherent gain built into the corporation. So what do we do here? What's the fix for it? Well, there's no magic pill. There's not a great fix for it. One thing we've done with a lot of them is we have converted to an S corp. When you convert to an S corp, there is this what they call the big tax, the built-in gain tax that applies if that land were sold within 5 years. And so as long as we're not going to move that land in the next 5 years, things like that, then this makes sense to look at, because once we get into the S corp status, S corp of course is flow through, whereas the C corp pays its own tax, the double taxation of the C corp. Now we are into this, I guess the fourth line down, where we can potentially create offsetting a gain inside and a loss outside because of flow through taxation. We don't have a C corp, so we can't do that. With an S corp, we do. So the S corp now sells the land or distributes the land. It has gain under 311B. It's got that gain. That gain comes out to K1 to the holder of the shareholder of the S corp. So shareholder of the S corp, when it has that gain, because it is a flow through entity, it steps its basis up even further in the outside basis. And so now we've got a very high outside basis. We distribute, and there is, on a liquidation, there is actually a loss recognized. And so if you've got an individual loss but a flow through gain, then you can offset them. You have to be very careful with timing and also character. So for instance, this loss over here that you're going to get from liquidating an S corp, that's going to be capital loss. If you've got a whole bunch of ordinary income that's flowing through, they're not going to offset. But if it's sale of, some land that's been out there for a really long time, that's going to be capital. It'll flow through capital loss and can offset. So you have to be careful with the character. Also the timing. I've seen one thing happen in 1 year and then the liquidation the next year. Well, that doesn't work. You've already had the gain on your 2022 tax return. If you're going to liquidate 23 and have the loss, there's nothing to offset. It could offset other capital items, but it wouldn't offset what the capital gain that was generated from the sale of the land or the distribution of the land. So, there's a lot of creative ways that you can handle this, but you really have to think through it. So what about an LLC versus C corp? Well, an LLC is going to give you generally the same liability protection. But the benefits of the LLC obviously are you can take distributions that are not going to be dividends. So generally, when you take a C corp, it's going to be a dividend to the extent you have E&P, earnings and profit. If you don't have earnings and profit, then it would go against your basis. So when you have an LLC, you've got a little bit more flexibility because you can distribute things out a little bit easier. If it is an LLC tax as a partnership, you've got that 754 election you can make. The C corp rate currently 21%. You probably all know that. A lot, what we're going to talk about here in a little bit with the estate tax exemption sunsetting, a lot of the things that were changed in the Tax Cut and Jobs Act are going to sunset. Primarily estate tax exemption, lowering the highest tax rate to 37%. That's sunsetting. If any of you are familiar with QBI, Qualified Business Income Deduction, that's all sunsetting. So sunsetting at the end of 2025. The corporate rate does not sunset though. So that's what they call permanent. Permanent in the sense that it's permanent until Congress decides they want to change it. They can change it anytime they want to, and there's always proposals to change it. So you've got that, and then you've got your dividend, which is generally going to be taxed at 20%. So there's your double taxation. If you're just have an LLC, well, you're just flow through taxation, capital gain rates, generally 15, 20%. State income tax 5%, and then depending on whether you materially participate in the entity or not, as to whether or not you have to pay that additional 3.8% tax on an LLC distribution. I'll note that C Corp is always subject to a distribution from a C Corp, or a liquidation is always going to be subject to 3.8%. Whereas if you're in an LLC tax as a partnership, you can get around it if you are active in the trader business and materially participate, which is, you could talk all day on Section 469 and what material participation is. So there it is up there. Going to get subject to the 3.8%. The LLC structure is a lot more flexible, and it also can be a variety of different types of taxpayers. Single member LLC is going to be a disregarded entity, one and the same as the single member for tax purposes. LLC that has 2 members, default is going to be a partnership. So the partnership concept, it's taxed as a partnership. A flow-through concept forms a Form 1065, sends K-1s out. An LLC can elect to be taxed as an S corporation. I see these sort of CLE events all the time that say LLC or S corp, which is the right answer. You better be careful with that, because there are a lot of LLCs out there that are taxed as S corps. So S corp is similar to the flow-through taxation of partnership, except it has some employment tax benefits, which is why a lot of people use S corps. However, they're not ideal for entities that are going to have a lot of assets that appreciate in value, because you don't have the 754 concept. So, and then an LLC can be a C corp. It's rare, but they can do it. All you got to do is file a form with the IRS 8832. Say, I want to be a C corp. You're a C corp. LLC does have a lot of flexibility. All right, let's talk a little bit about moving on from income tax to estate tax. A lot of the estate planning that we're doing now is, because of our estate tax exemption is so high, we're doing a lot of basis planning and incorporating a lot of structure and flexibility in our documents that were not necessary, 15 years ago, because we weren't as worried about income tax because our basis was so low. The primary goal was to avoid income tax, and we didn't have portability, which means if I die, my wife can port over my exemption, and then she can use that plus her exemption. So current estate tax rate, 40%. Gift tax and GST rate are also that. GST, generation skipping transfer, that is a transfer that skips a generation, grandparent to grandchild. That is a separate tax from the estate tax, totally separate. And it is also 40%. And you have the same exemption as the estate tax for that. So in the wrong situation, you can end up with a grandparent leaving assets to a grandchild that is subject to both a 40% estate tax and a 40% GST tax. And so that, when you do the math, it ends up being about 67%. Because you do 40% estate tax first, and then 40% of what's left over as GST tax. So again, the lifetime exemption right now, 12.92 million. So married couples, that's almost 26 million. Next year, it's going to be over 27 million. It's going up to 13.61 million in 2024. GST exemption is the same. However, as you see there, portability. So with portability, you can have what's called a DSU, deceased spouse unused exclusion amount. So again, I pass away, my wife can port over my unused exemption, and she can use that plus her exemption. However, the GST exemption is not portable. So if someone dies and leaves all their assets outright to their spouse, well, they're not going to have an estate tax problem, but they've lost their GST exemption. So that's why we use, in most cases, a marital trust, is a trust for the benefit of the spouse that we can also allocate our GST exemption to. And ultimately, you would make on the wife's what's called a reverse Q-tip election to do that allocation. But that allows you to sort of maintain your GST exemption because it is not portable. So the big news everybody's talking about, sunsetting. January 1st, 2026, we're going to wake up and the estate tax exemption is going to go from approximately 14 million to 7 million. And so that creates this use it or lose it scenario where if you had this $14 million exemption and you didn't use it, it's gone. It's back down to 7. However, since the way they count it, bottom dollar first, in order to take advantage of that use it or lose it, you have to have made a gift in excess of what it's sunsetting back down to. So if it's $7 million, you go make a $5 million gift, and it sunsets back down. I mean, if it's $14 million, you make a $5 million gift, sunsets back down to 7. Well, the bottom dollar's first, that $5 million's gone, so you got $2 million left. If you made a $10 million gift and it sunsets down to 7, there's no callback on your excess that you made. So that's what they call use it or lose it. So there's going to be a lot of, probably a lot of chatter over 2024 and 2025 of whether this is actually going to sunset or not. I think there's high probability it will, and a lot of that depends on what happens in 2024 with the elections. But it's sort of low-hanging fruit for both Democrats and Republicans to just let it happen and not be the bad guy. Say, well, we didn't do this. This is Trump's fault, or whatever. I mean, you can see this, and you can see the narrative play out depending on which side you are. But I think it's probably likely to happen. We're at historical highs right now. Keith and I were talking the other day about what Europe is and what other countries are like. I mean, in the UK, it's like $1 million, between married couples, and so we've got $27 million between married couples. So it is eventually probably going to go down.
Charles, just simplify this. Anybody that passes away today and has an estate that exceeds 13.61, they're going to pay taxes at 40% rate, more or less, on that excess. And in 2026, that's going to drop down to about half of that, more or less, about $7 million. So you have the opportunity to take advantage to shelter that difference before that happens and not have to pay 40% when you pass. So you put it in a trust using the gift exemption and take advantage of that.
Yes.
If you had ag land, you could put it in a trust for your children. And could that trustee then give you back a lease of some sort?
Yeah, as long as you're paying fair market value. Absolutely.
They give you a lease, so you could continue to use the land for agricultural purposes. You're just not going to own it because it's going to be in the benefit of that trust.
Yeah.
For your heirs, right?
And guess what? You can control who the trustee of that trust is. So.
If you don't do that and you pass away, you're going to pay at the rate of 40%, at least on that $7 million, which would be $2.8 million or so in estate taxes. That planning could allow you to fulfill.
That's right. Not only that at current, but also all the future appreciation as well. Yeah.
What all falls under someone's estate?
Everything you own. Everything you own. Your house, your Rolex, your car, everything. So it all counts. And also, one thing people don't think about a lot, life insurance. If you own a life insurance policy that you are the policy owner, it doesn't matter where the money's going, that is included in your estate, the proceeds. So if you got a $5 million life insurance policy, well, that's $5 million you just added to your estate. And that's the reason why a lot of people will use what's called an ILET, which we're going to talk about on the next slide. But Keith, to your point, there is what we call a deferral mechanism via, if you have a spouse and you leave everything to your spouse in a trust or whatever, there's an unlimited marital deduction. But ultimately, that's the end result. So.
You're just going to appreciate her name, and then when she the husband.
Yeah, and then when she passed away, it's includable in her estate. Yeah.
It's
So.
planning along the whole life instead of just for the end.
Yeah, and what I'll talk about a little bit on the next slide, I get a lot of not necessarily pushback, but people are afraid of the word trust. They don't like they view this trust as this mechanism that's used to lock things up and never have access to them and things like that. And that probably was what trusts were in the 70s and 80s. But I mean, today we've got the Uniform Trust Code. We've got a whole bunch of revenue rulings, from the 90s leading up, to probably recently that have blessed a lot of power, structure, flexibility changes in a trust. For instance, I can set up a trust and I can retain the right to remove and replace that trustee for any reason I want to. So I name a trustee in the document, but I reserve the right to change my mind at any time. And so I still control everything indirectly, but I still control. If that trustee doesn't do what I want him to, he's fired. You know, I'm gonna go put someone else in there. So there's a whole lot more flexibility and structure that you can create with them now. That just makes a SLAT, a spousal lifetime access trust. You know, you set it up for the benefit of your spouse. You're essentially still a beneficiary indirectly. You know, there's some powers of appointment you can put in there where she can convert it back to you. I mean, there's all kinds of flexibility and ways that you can do these that maybe weren't being done, you know, back in the 70s, 80s, even 90s. And then we didn't have the Uniform Trust Code. The Uniform Trust Code gives us a whole lot of flexibility and powers that we can do these non-judicial modifications. Everybody agrees we do it. We don't have to worry about the court. We can get the court involved if we need to. There's just a whole lot of reasons why it really makes sense to look at making these gifts now, because you can have your cake and eat it too with the current trust structures. Go through this slide and then a little bit more on trust. So annual exclusion amount. Annual exclusion is I can gift $17,000 to anyone I want to, as many people as I want to, and it does not count against my estate tax exemption. It doesn't have to be any sort of family relationship. I could give $17,000 to everybody in this room and it wouldn't count against my estate tax exemption. So if you're married, double that, $34,000. You know, so if you think about, let's just say you're a grandparent and you've got 10 grandkids. You can move, just with your grandkids, $340,000 a year out of your estate. And not only that money, but the future appreciation as well, without even costing yourself anything. So when you're doing grandkids, you do need to consider GST. And there's a special type of trust called a 2642C trust to accomplish that. That's going up to $18,000 in 2024. And then the other thing to do, charitable gifts obviously don't count against your state tax exemption, nor does paying for educational or medical expenses. So educational expenses, you're paying for a child or a grandchild or someone to go to college, or even just go to Lee Academy, just right up the road. As long as that check is paid directly to the educational institution, it does not count against your gift tax exemption. If you give it to the child or the child's parents and then they pay Lee Academy, well, that does count because you made a gift to them. But if you do it directly to the institution, it doesn't count. Same with medical expenses, health insurance or medical expenses. Pay the provider directly. You know, pay the hospital bill directly. Don't give them the money to pay it, and then it won't count against any of this. All right. Well, I guess the trust is on the next slide. All right. Real quick, pros and cons of lifetime gifting. The pros: use your exemption while the rates are at all-time highs. That use it or lose it scenario. Not only are you taking advantage of your current gift tax exemption, but you're also removing all the future appreciation. We can leverage discounts to move higher net asset values than what we're actually costing ourselves from a gift tax exemption. We can shift income downstream. We can move these partnership interests that are generating income annually. We can move them downstream, put them in a trust or whatever for the benefit of our children, heirs. The children can use the property immediately. I mean, this doesn't necessarily apply in all scenarios. It's creditor protected. If I own something, my creditors can come get it. If I set up a trust for my kids and put it in there, it's protected not only from my creditors, but also from their creditors. So, and then the gift tax is inclusive compared to estate tax being exclusive. What that means is if you have $1 million that's subject to estate tax, you are actually paying that tax with dollars that themselves are subject to estate tax. So, you know, if you want to gift somebody $1 million in a state, if at the end of the day you want someone to have $1 million, in order to do that from an estate tax standpoint, it actually takes $1,640,000 to end up at $1 million, because not only is that million tax, but the 640 is also itself subject to tax. And so that's why it's more. If you're doing it from a gift tax perspective, well, you give them $1 million and then you're using other non-tax money to pay the gift tax. And so it only takes $1.4 million. And so when you do the math, the gift tax is actually, when compared to estate tax, is actually about 27% versus 40%. there are circumstances where we recommend making taxable gifts that are going to be subject to tax because of this reason here. You're going to pay it at a lower tax rate. These are people that have so much money, they're paying tax anyway. Let's go ahead and get the most efficient bang for our buck that we can. The big con of all this is you lose the step up in basis. So let's take this scenario Keith was talking about where you got the farmland and we're going to transfer it into a trust. Well, the downside of that is you lose the step up in basis to the fair market value at death. But number one, this is land that you probably want to be in the family. It's going to be farmed for generations, not planning to sell it. So we probably don't really care about the basis. And number two, you're saving 40% estate tax versus capital gains rates, of 20%, 25%. And so even losing this basis is probably still the right call. Of course, everything's situation specific, but it's still the right call in a lot of scenarios. And the other thing to think about with the estate tax, and particularly people that have what we call asset-rich, cash-poor. Lots of farmers. They got a ton of value in land, things like that, and they may not necessarily have the equivalent amount of cash. Those folks, if they're going to end up having to pay estate tax, they got to come up with that money somehow. They got to come up with that cash somehow. And so when you have illiquid assets, that becomes a problem. And unfortunately, a lot of businesses, land, things like that, have ultimately ended up having to be sold to pay estate tax. There are ways to mitigate that. Life insurance, there are plenty of other ways to mitigate that, but that's also a consideration there. So the other kind, you lose the use of it. You could certainly rent it back, like Keith was saying, but it does have to be true fair market value. Fair market value of croplands renting at $100 an acre, you can't rent it for $10 an acre. You got to pay the fair market value. You lose control of it, but that's not really true because of what I talked about earlier. You still have indirect control. You control who the trustee is, and so you still have a whole lot of say in it, even though you don't directly control it. You lose the income, and then the potential negative effect on the productivity of a beneficiary. Creating what we call a trust fund baby or something like that. So you always want to be aware of and cognizant of that. No, not very often. Yeah, not very often. So you'd be surprised. So all of this, estate planning as a whole, particularly for these very wealthy families, it's super important to consider family dynamics. But also family values. What's the family value system? Do the kids understand the family value system? Is there sort of a family code of ethics, if you will, things like that. So there, you can get really deep into all that in psychology, and you certainly have to factor in more than just tax when you're doing this stuff. Tax. I always say, don't let the tax tail wag the dog. Tax is important. But it's not the most important thing. People, relationships are obviously more important than tax. All right, this is really small, so I apologize for that. Different types of trust. So at a very high level, you've got two types of trust, a revocable trust and an irrevocable trust. People tell me all the time, I've got a trust, I've got this, I've got that. Well, trust is a loaded term because there's about 50 different types of trust, So, depending on what type of trust you have, that allows me to tell you what the benefits, pros, cons, etc. are. So a revocable trust. This is a trust that is what it says it is. A lot of people call them living trust. It's a trust that you set up during life that you can revoke, change, amend anytime you want to. The primary reason that people use this is to avoid probate. So probate is the process of transferring assets from an decedent's name to the beneficiaries. If everything's in the name of the trust when I die, well, my trust still exists, so they don't have to worry about probate. So we use it for probate avoidance, particularly with out-of-state property. If somebody lives in Mississippi, they say, well, I'm fine going through probate in Mississippi, I don't care. But I've also got a house in Florida or a house in Montana or Colorado or whatever. Well, if that house in one of those other states is in your name individually, well, now you've got two probates, So put those properties in either an LLC or a revocable trust so that if you are going to do one probate, you're not having to go do a second probate in another state for out-of-state property. We use it for management reasons during incapacity. Typically, a revocable trust would be set up. The grantor of the trust would be the trustee, so I set up a revocable trust. I'm the trustee. I control everything while I'm alive. If I become incapacitated, then that trust can serve as a management vehicle for the successor trustee to manage those assets on my behalf and for my benefit while I'm incapacitated. Very similar to the role that an agent under a financial power of attorney would play, but it's a little easier if everything's inside of a trust. Privacy concerns. If you go through probate in Mississippi and most other states, your will is public record. So if you have all these detailed gifts and things like that in your will, and some, who nosy pair, I don't know why they would want to know this, but they can go look your will up and read everything in it. If you have a revocable trust, even if it's unfunded, meaning you didn't move your assets into it during life, so now you got to go through probate, well, all your will says is, I leave everything to my revocable trust. It's pour over will. And so that's all they know, is that everything went to a revocable trust. But the trust itself's never filed. So a lot of people use these for privacy reasons. What they're not good for, creditor protection. Zero creditor protection whatsoever. They do not provide 1 ounce of creditor protection. Very common misconception. Oh, I got my assets in a trust, they're protected. Well, not if it's a revocable trust, which most people that say that it is a revocable trust, they're not protected at all. From a creditor standpoint, a revocable trust is one and the same as you. From a tax standpoint, IRS, it's also one and the same as you. So it doesn't create any tax benefits or tax downsides, really. Just everything stays the same. Everything still is reported essentially on 1040. 5 minutes? All right, irrevocable trust. These are types of trusts we would talk about when we're making our gifts. So the most irrevocable basically means what it sounds like. It's irrevocable. You can't modify it. You can't change it. You can't amend it. Though we laugh now when people say that because of the Uniform Trust Code, very easy to modify or change trust. We can do non-judicial modifications. There's a whole list of judicial modifications. And if you're at a chancery court in Mississippi, the judges aren't even going to read what you put in front of them. They're just going to sign it because they don't know any of that stuff, and they're just trusting that what you put in front of them is right. So these judicial modifications, to the extent needed, are also very easy to do. So irrevocable doesn't mean what it used to. Now, anytime you're doing a non-judicial modification or a judicial modification or a non-judicial settlement agreement, you got to be aware of potential tax consequences. So you can't just do whatever you want because there are potential tax consequences to it. But point being, these things are really flexible now. And then we also have a concept called decanting, where it's a trustee distributes from one trust to the trustee of another trust that has different terms on it. So it's very easy to fix these old trusts. And I do a lot of non-judicial modifications of trusts that were done 20, 30 years ago. So the most common type of trust that you'll probably see is a marital trust. A marital trust is a trust that is designed to hold assets for the benefit of a surviving spouse. We use this for a variety of reasons, one being GST exemption. GST exemption is not portable. We can leave assets in a marital trust to allocate GST exemption. Another reason people really like them is that marital trust is for the benefit of the spouse. The spouse can even be the trustee of it, still control it and everything. But you say what happens at death. So I can say, okay, to my spouse while she's alive, and then to my kids at death, and I don't have to worry about some second husband coming in there and taking all this money, because I've left it in a protected environment of trust for my wife. Particularly if you got blended families with different kids, stepkids, things like that, it becomes even more important. The most common marital trust would just be what we call a testamentary trust, one that comes into effect at death, and that could either be baked into a revocable trust or a will. But there are reasons why sometimes we'll use a lifetime marital trust as well. ILIT, Irrevocable Life Insurance Trust. Estate planners love acronyms. I could probably give you 50 different ones. So an ILIT is a trust that is designed to hold an insurance policy and keep the proceeds of that insurance policy from being included in your estate. So I go get a $5 million life insurance policy. Instead of having me be the owner, I set up a trust, and the trust owns the policy, and the trust is the beneficiary of that policy, and it says, this trust is for the benefit of my wife and kids. So that policy, in order to pay the premiums, I would make a gift into that trust every year, and it would generally be covered by annual exclusion, so you wouldn't have to worry about it. And that would allow that $5 million to not be included in my estate and count towards my estate tax exemption, but yet still there for the benefit of my family. Also still there to buy assets out of my estate in the event my estate needs some liquidity to pay taxes. So that's, when I said life insurance is used to address liquidity problems, we would still use it in an ILET so that we're not compounding the estate tax problem with more assets, but that trust can then buy certain assets, buy farm, whatever it needs to give liquidity there. And so that's the ILET. Used to be super, super common when the exemption was like $1 million. Still have their role. We still do a lot of them today. Domestic Asset Protection Trust. This is a special type of self-settled trust. That self-settled means I set it up for myself. In general, public policy would say if I go set up a trust for myself, there's no creditor protection because I shouldn't just be able to transfer all my money into a trust and then go do whatever the heck I want to and not worry about the consequences of it. But a domestic asset protection trust is a special type of trust where you actually can do that, but it's designed to hold like a nest egg or something like that. We do a bunch of these for doctors, folks that are in high-risk professions. And then you get down to the irrevocable dynasty trust. This is going to be the center estate planning piece for most folks, or should be, that have a taxable estate or close to taxable estate. This is the trust that we're going to use to gift all of our assets into. We're going to retain the right to control who the trustee is. We're going to retain certain powers over it. The trustee can be the kids if you want them to. It could be the spouse, it could be whoever you want to. But again, there's sort of a way to change that if you need to down the road. And then you can also have a trust protector, which is like an advisor, a family friend. Real quick, SLAT. I want to talk about a SLAT. A lot of folks say, I don't want to give away this much money right now because, I'm borderline taxable estate and I'm concerned that I'm going to lose the benefit of it. Well, SLAT is really how you can have your cake and eat it too. Spousal Lifetime Access Trust. Spouse is a beneficiary. You need money, you just take a distribution to the spouse, assuming you're on good terms with your spouse. And then, you've got the money available for use. Again, you control who the trustee is. It can be the spouse. It can be someone else. You can change that whenever you want. And then there's power of appointment as a way to sort of get the money back, if you will. So anyway, point of all of this is don't be afraid of a trust. There is so much flexibility with trust nowadays, both from a tax planning standpoint and from an operational practical standpoint. So it is a great vehicle, not only just to use your exemption like we talked about, but also for your long-term sort of dynastic type planning such that these assets pass down generationally in a proper protected environment. So I'll close with that. Looks like I'm out of time. So.